How do we know whether a Roth conversion makes sense for your retirement? Well, we need to find if there is a tax benefit from the Roth conversion. Well, how do we do that? What tax number do we focus on? Unfortunately, as of late, I've seen from a lot of tax planning calculators, from a number of advisors, even from retiree plans, I see the wrong tax number being focused on, and it leads to suboptimal Roth conversion decisions, and at worst, can even lead to tax losses from that given Roth conversion. So in this video today, I want to talk about what number you should be focusing on in order to find the best strategy for your situation. Let's get into it. Now, to start off, on the screen I have two forward-looking tax graphs from the same retired couple. This couple is 65 years old, and they have about $1.5 million in traditional IRA assets. They also have Roth and taxable assets there on the outside. Now, as we can see from these two graphs are from the same retired couple, but we can see they're wildly different. If we look at the traditional withdrawal strategy on the left-hand side of the screen, this is a strategy that entails taking from their taxable account first, taken from their IRA second, and Roth accounts last. And as you can see in the traditional withdrawal method, this person's situation is getting quite cost heavy later in retirement from RMDs and all of the kind of coordination of tax hurdles they will face. On the right-hand side of the screen, however, we are looking at them converting a little bit heavier on the front end of their retirement. This is called the take no IRMA penalties strategy, where they're not going to take any Medicare increases. Now, we can see from the naked eye that the right graph looks like it should deliver a lot better tax savings. But how do we actually know? Is there a given tax number that we can look at that will show and fully explain the tax benefit or what we're giving up from a tax standpoint from one strategy versus another? Well, let's first talk about two tax numbers you don't want to focus on that I see a lot of retirees focused on that leads to some optimal decisions. The first is looking at the total taxes paid and then solving and performing a tax strategy based on the lowest total taxes paid. And this seems like it should be a number that leads to the best tax decision. But if we understand what's going on here, we can see that it actually doesn't. And on the screen, you can see that the traditional withdrawal method has the highest amount of taxes you would pay moving through time. The take no IRMA penalties is right in that middle range. And then I also added in a max the 32% bracket strategy that shows actually the lowest total taxes paid. So does this mean we should max the 32% bracket, get a little bit more aggressive here on the front end for this 65-year-old couple? And the answer would be no. The problem here with focusing on this exact tax number in order to inform your Roth conversion decision is you're making an inherent assumption that a dollar worth of taxes today is the same as a dollar worth in taxes 20 years from now. And that's not the case. We know there is inflation moving through time. And so that at least needs to be discounted by inflation. But even that wouldn't be accurate. Because again, we're growing at an investment rate within our portfolio likely higher than inflation. And so you'd actually want to discount by that investment rate. And even at that point, I'm not entirely certain that would still be the tax number you want to focus on. Typically, when you focus on looking at the lowest tax strategies period, it's going to lead to a lot heavier conversions. Again, this makes sense. We'd be paying a larger tax liability right off the bat, but we'd be paying it in today's dollars at one time. Versus taking that money out over time, we're going to see that tax liability naturally grow just due to inflation. And so don't focus on the lowest tax strategy. This will certainly lead to heavier conversions, and those heavier conversions typically lead to tax losses in reality. Next tax number that would once again be a mistake to focus on is looking at the lowest effective average tax rate. And so we know that on an ongoing basis, when we look at all the taxes that we paid throughout the year relative to the income we generated, that's going to deliver to us the effective tax rate that we paid. And so again, if we're just thinking at a surface level, it can make sense to think that we want to solve for the lowest average tax rate. But once again, the problem here, specifically with using averages, is it's going to skew towards heavier conversions. And I have this proved out here in two different scenarios here. So let's say in the first scenario, we're doing a heavy conversion. We convert all of our assets in 1 year. We pay a 30% effective tax rate. And then every year thereafter, we don't pay anything in taxes because we have all Roth assets at that point. Versus in the second scenario, we look at paying a 15% effective tax rate each and every year through retirement. What you would see if we just average together 6 years is the first scenario shows a 5% average tax rate. The second scenario, however, shows a 15% average tax rate. But if we just think about this and we think about the rates we're paying today versus the rates over time, we paid a lot heavier than a 15% tax rate in the first example, which means it will lead to tax losses. Versus in the second example, we maintain that more static but flat tax rate moving through time. So then the question is, what do you actually want to focus on? Now, before just giving you the overall tax number, let me explain the calculations happening in the background, because these can get a little bit complex. And there are three main variables that we care about within the background of this calculation. The first is your expected tax liability if you stay alive in retirement. The second is the tax liability you would pass on to the next generation. And then the third is your longevity. And so depending on when you pass away, those numbers will adjust slightly. And with most retirement plans, we're typically building out longevity a little bit further into the future. So for this specific plan, you can see that we're looking at a 30-year retirement, which brings the longest survivor of this couple out into age 95. And if this person lives to age 95, what you see on the screen right now with the graph is what we should expect again in that median trial. We can run the calculations and see Roth conversions from here and see whether it's beneficial relative to the rates we pay today versus the rates we'd see over time. But even this graph doesn't show the taxes owed after death. And so we can see from the ordinary income bars, this dark blue bar that keeps growing through time, that their RMDs are growing through time, which means they have a traditional IRA left at the end of their life. And so as they pass that on to the next generation, there is a tax cost the next generation will have. Well, we can take this a few steps further, however, and ask the question, what happens if they don't live to 95? What happens if they pass away at 88 or even sooner in retirement? Now we see the tax graph will change slightly. We'd move up the end of this tax graph, but we'd still have the same dynamics working out that we'd be passing a tax liability to the next generation. And so again, when we're thinking about the expected after-tax value, we care about the expected after-tax value if the retiree stays alive, if they pass away, and then the longevity, when they're going to pass away. And so combining all of these variables together for a specific retiree will deliver a tax graph like what you see on the screen here. And this is just looking at more brute force, maximizing specific brackets here. Now on the y-axis, you see the tax benefit or tax loss from these given strategies. And then on the x-axis, you see the years in retirement. And so this is showing if this person passed away at any given point in time, or they ended up living to a given point in time. This is the expected tax benefit of each given strategy, looking at the taxes saved while they were alive, as well as looking at the taxes saved when passing to the next generation. Now, this is a powerful graph and one that I don't know that you can find anywhere else. This is part of a software package that we've been putting together behind the scenes here at Safeguard, because honestly, there's a lot to be desired when we look at Roth conversion calculators or software options. And so without being able to see a third-party option, we've gone and developed our own here internally at Safeguard. Now, right now, this software package is something that's currently in what I'll call an alpha stage, where we're just still working through it, making sure there are no bugs in the software. It will then move into a beta stage we start using with clients. And then hopefully at some point, we will be able to put this in a software package that the rest of the public can purchase and have access to. And the graph you see on the screen right now is one we designed as an output from this simulation software. And the reason I think it's so powerful for retirees is the best strategy, or the tax benefits from the best strategy, is not a static thing. It's not as if regardless of when you pass away, you're going to receive the same tax benefit. In fact, as you can see on the screen, and this might be difficult to see based on the scale of the y-axis, shows that starting out a smaller max the bracket strategy is optimal. So for instance, we see for the first about 10 years, maxing just the 10% bracket is most optimal. And this makes sense if you think about this. In the traditional method, we'd be taking from our taxable account first, and we'd have next to no tax liability because of it. We'd barely be filling up any brackets because, again, this retiree would be mostly in that 0% bracket as they filled in that capital gain income. So instead, what we'd do is we'd be maxing out the 10% bracket, and that would lead to tax benefits, especially if this person passed away in the first 10 years, because they'd be saving on taxes to the next generation. But as this person starts to see RMDs in their retirement, we start to see that the maxing the 10 or even the 12% bracket starts to be a suboptimal decision. Instead, we see maxing the 22% bracket, or even a more aggressive strategy like the 24% bracket, starts to beat some of the smaller max the bracket strategies. And this is exactly what we would expect and why there isn't a perfect answer in what Roth conversion strategy is best for your situation. It depends entirely on where we're comfortable succeeding and where we're comfortable failing. For instance, you can see that some of the more aggressive tax strategies in the first, let's call it 15 years of this person's retirement, if they passed away, would actually result in tax losses. Now, depending on the likelihood you think that you will pass away in the first 15 years, will inform which Roth conversion decision you ultimately choose. And so again, the correct way to calculate out whether there is a tax benefit for any given conversion strategy is looking at the expected after-tax value, both while you're alive and what you would see from expected growth, RMDs, and those given tax hurdles, and then as well when you pass away, what you'd pass on to the next generation and what their tax liability would be. So hopefully this video helped you gain a better idea when you're presented with a tax number for a Roth conversion strategy to take an extra look at it and make sure it's the right number to focus on to gauge that tax benefit. Also, if you found this video interesting and you're looking to learn more on how to optimize your retirement, make sure you're subscribed to our Safeguard Wealth Management YouTube channel. With this Roth conversion simulator, it is going to open up a ton of content for case studies and extra levels of analysis that we can provide you, but make sure that you're subscribed to gain that knowledge. As well, if you're looking for a little bit more information on how to gauge the tax liability that you will pass on to the next generation, we just recently recorded a video that you can click on right here that talks about this crucial tax variable in your analysis. Thanks for watching, and always remember, you don't need more money, you need a better plan.